Welcome to another Rogers Capital Market Commentary, where we attempt to be the antidote to water cooler wisdom. Well, 2023 is off to a great start. Right direction, when you say 6% gain in January alone. We talked a little bit last time about what follows tough years. And do you remember the answer? It's usually rebounds. A positive January also means for us that the trifecta has come into play. You say, what's the trifecta? Well, that's three things. Number one, positive return during the Santa Claus rally. That's the 7 trading days that follow Christmas. Number two, the first 5 days of January. Those are also positive, which they were. And then number three, if the month of January is positive, which again, we now have. So we've got the trifecta in play. This indicator has hit 31 times since 1950. And in those 31 times, the average return for January has been 4.6%. So not even as good as we have just had, 6% in January. But more than that, they've gone on to add more than 12.3% over the rest of the year. So yeah, that's right, I'll do the math for you. That means an average gain of 17% in a year when we hit this trifecta. Also, the average gain in the third year of a 4-year presidential cycle is 16.8%. And the year following a down year, we talked last time, 15% average gain. Furthermore, of the 4 trifecta years that overlapped with a recession, which again we're likely to have this year, annual returns were all positive and averaged 34.8%. Even in years with negative or limited earnings growth, we yielded positive average annual returns. Now, by no means is this trifecta foolproof. These seasonalities flawless, as pricing patterns and historical tendencies, obviously not a guarantee of future results. In fact, earnings have not been the greatest coming in here, these fourth quarter earnings. The housing situation we've talked about a little bit, it's really not good. In fact, last week there was an article, KB Homes in their fourth quarter earnings report confessed to a 68% cancel rate on new home contracts. And that's higher than we saw in 2008. Now, this is not 2008, but the impact of housing is going to be interesting to watch. And of course, the Fed, something we have watched for months and months now, their response to inflation is going to be something to watch. So it's not all roses with this trifecta historical math. We've got some negative things going on, but we will always have negative things going on. And at some point, in fact, more and more now, history, the math is on the side of a rebound. Now, speaking of the Fed, as expected, the Fed raised rates by 1/4 point earlier this week, which puts us at 4.75% on the Fed funds rate. And wow, what a difference a year makes. A year ago, we were at 0.25% on the Fed funds. A year ago, we were essentially zero, almost zero. Inflation had actually reached 7.9% this time last year. The 10-year Treasury yield was 1.79%. Inflation clearly had more upside, and from this vantage point, the Fed was late in pursuing stability. We've talked about this in previous videos, but clueless or, lying to us about transitory inflation. I don't know which. But the Fed obviously late to the game. According to yesterday's Fed statement, in fact, the committee's obviously comfortable accepting that inflation is easing, which is good news. This is a baby step toward a pause, which likely will not happen until later this year, since the Fed is expecting rates to be raised at least once, at least one more time this year. But when investors compare the Fed's February statement to December's statement, well, you have to conclude that the days of runaway inflation, hikes of 75 basis points, 50 basis points, really anything more than 25 basis points like we just saw, are likely over. Seems the committee no longer worries about the pace, but is now more focused on the extent of those increases or the duration of those increases, which is good news. So, come on, Trifecta. We'll talk to you next time.